In March 2002, the CEO of an education technology company called Chegg spoke on an earnings call. He was explaining why the company's growth had slowed. He said the word ChatGPT. The stock dropped 48% that day. Not 48% over a quarter. Not over a year of disappointing results. In a single afternoon. Chegg had been one of the most successful education companies of its generation. Millions of college students used it for homework help, textbook rentals, and on-demand tutoring. At its peak in 2021, the stock traded at $115 per share. By the fourth quarter of 2025, revenue had fallen 49% year over year. By January 2025, the company had eliminated 319 employees. By May, another 248. By October, 488 more, 45% of the remaining workforce, in a single cut. In total, across 2025, more than half the company gone. Not because the product failed, because students stopped coming. Because they found something that answered their questions better, faster, and for approximately $0 extra per use. That is the mechanism. And Chegg is the cleanest timestamp on a list that runs across 5 job categories. This is Last Shift, where we document what happens when work begins to change. Here are 5 jobs that were done primarily by humans in 2023, and are done primarily by AI now. Not because anyone declared an emergency, not because there was an announcement, because, in each case, the AI tool crossed a threshold, and the economics of the human role could not survive the crossing. The standard framing of AI in jobs. Displacement will be gradual. Warning signs will be legible. Time for retraining will exist. The data from 2023 to 2025 describes something faster. In each of the 5 roles below, the AI tool reached functional adequacy on the core daily work in a narrow window of time. Not perfect, functional. Good enough that the business case for paying a human full salary, full benefits, and full overhead to perform that same work became untenable. The mechanism across all 5 is the same. The role did not end through mass termination events. It ended through attrition not refilled, through job postings pulled and not reposted, through new workflows built AI first that did not include the human function at all, through contractors who stopped getting booked, through platforms where the students stopped arriving. The job category did not announce its own transition. It happened through 1,000 separate business decisions, each rational on its own terms, all pointing the same direction. Here are 5 of them. Job 1. The recruiter. At the center of a recruiter's job is a simple act, reading resumes. A position opens. 70 people apply. The recruiter reads 70 resumes, 2 to 4 minutes each, selects 12 for phone screens. Of those 12, 5 advance. 2 reach the hiring manager. 1 gets an offer. That filtering function was the core volume work of recruiting, and it required a human because, as the theory went, a human reads between the lines in ways a machine cannot. Context. Trajectory. The unstated things that distinguish a candidate from a keyword match. By 22, that theory had been overridden by scale. 82% of companies are now using AI to review resumes before a human recruiter sees them. Not assistance, primary review. The AI scores resumes against job descriptions, ranks candidates, eliminates those who don't meet minimum criteria. The human recruiter receives a filtered, pre-ranked list. They do not receive the 70 resumes. They receive the 12. The judgment call that defined the recruiter's role, who gets to the phone screen, has been delegated to an algorithm running in milliseconds across every application simultaneously. McDonald's processed over 2 million job applications globally in 2024, using a single AI recruiting tool called Olivia. 2 million applications. 1 AI system. The number of human recruiters required to pre-screen 2 million applications would be enormous. McDonald's reached the first round of human judgment. after the AI had already done the work. Unilever implemented AI-driven candidate screening that saved approximately 70,000 hours of human interviewing and assessment time. That is what roughly 35 full-time recruiters produce in a year. That work is now handled by automation. 23% of companies now use AI to conduct structured first-round video interviews, asking preset questions, analyzing responses, scoring verbal and nonverbal cues before a human interviewer enters the process. That figure is projected to reach 29% by end of 2025. 66% of companies now use AI to write the job descriptions in the first place. The progression is consistent. The recruiter's function, step by step, moved from doing to reviewing. Between 2022 and 2024, hiring volume dropped significantly across much of the tech sector and broader corporate market. The AI tooling absorbed the remaining work. Staff who left were not replaced because one person supervising software could absorb what 3 people processing files had previously done. The recruiter's role was to be the human filter. The filter became algorithmic. The human became the reviewer of the algorithm's decisions. That is a smaller job, differently paid, with different expectations. The person who built a career, reading resumes, conducting phone screens, and making judgment calls about who deserves a chance. That person's primary value proposition was replaced before they were told the replacement was underway. Job 2. The bookkeeper. For most of the past century, the bookkeeper was the economic infrastructure of the small business. Every dentist's office, every landscaping company, every local restaurant, every 3-person legal firm had someone whose job was to keep the books, record transactions, reconcile bank statements, match invoices against purchase orders, produce the monthly report. The bookkeeper required accuracy, consistency, and the discipline to update records regularly. A middle-skill role that appeared in every corner of the economy. Reliably, because as long as they were transactions, something had to enter them, categorize them. The accounting software revolution of the 1990s and 2000s changed the tools but not the function. QuickBooks reduced time per task, but did not eliminate the person doing the tasks. Someone still had to open the software, review the import, categorize the entries, flag the discrepancies. By 2024, that someone was increasingly a machine. Modern AI-capable accounting platforms now categorize transactions automatically as they arrive from bank feeds. They reconcile statements without human review for the majority of entries. They flag discrepancies for attention, generate basic profit and loss reports on schedule, and handle accounts payable and receivable through integrations with vendor systems. They learn from corrections and apply them to future transactions without being told twice. The bookkeeper's job was to do all of those things. The software now does them continuously, automatically, and without error rates that require a second human to check. AI-first bookkeeping services, Pilot.com, BotKeeper, and others, now operate with dramatically smaller human teams than traditional bookkeeping firms. Bench Accounting, one of the largest AI-assisted platforms for small businesses, shut down in December 2024, was acquired in the same period and restructured entirely around an AI-assisted model with a fraction of its previous human staffing. The Bureau of Labor Statistics projects a 4% decline in bookkeeping, accounting, and auditing clerk employment through 2032. The World Economic Forum identified bookkeeping and payroll clerks among the fastest declining job categories globally. Accenture estimates up to 80% of accounting duties can be automated with current technology. Deloitte's internal data found AI halved the time staff spent on routine accounting tasks within adopting firms. The math for a small business owner changed completely. Paying a bookkeeper $45,000 a year required that the bookkeeper's time was irreplaceable. When software does the daily work for $30 a month, irreplaceability became conditional on doing something beyond the daily transactions. Most bookkeeping jobs were the daily transactions. The version of the bookkeeper that survived is the one who moved upward. Financial analysis, advisory, tax planning, complex multi-entity work that requires judgment the software cannot provide. That role is stable. The bookkeeper who entered transactions, reconciled accounts, and produced standard reports, whose function matched exactly what the software now does better, faster, and for less. That position was eliminated when its holder left and not filled again. The reliability that made bookkeeping a stable career became the reason it was trainable. Consistency is what you teach a model. Everything consistent about the bookkeeper's work is now automated. What remains is the entire remaining job, and it requires fewer people to do it. Job 3, the data entry clerk. The definition of this job is almost impossible to misunderstand. Look at a document. Read the numbers, names, and fields. Type them into a system. Repeat. Medical records clerks entering patient information. Insurance processors transferring claim details from paper into claim systems. Logistics coordinators updating shipment manifests. Accounts payable clerks moving purchase orders into billing systems. The Bureau of Labor Statistics counted approximately 150,000 dedicated data entry keyers in the U.S. In 2022, millions more in adjacent roles where data entry was a primary function. The core requirement: eyeballs connected to fingers, producing accurate transfers from one format to another. What made this job secure for decades was not skill scarcity. It was the impracticality of alternatives. Before AI, automating document reading required expensive custom software built for specific structured forms. When a form changed, the automation broke. Human workers adapted. Machines did not. By 2024, that adaptability advantage was gone. AI document processing, optical character recognition combined with machine learning that interprets meaning, not just characters, now reads and extracts data from forms with accuracy rates of 99%. Higher than the 85 to 95% typical of human entry, which includes fatigue errors, transcription mistakes, and misread handwriting. The machine does not get tired 4 hours into a shift and slightly misread a zip code. It processes in seconds, continuously. One manufacturing company documented the shift. It reduced its invoice processing team from 4 full-time employees to 1 using AI automation. Annual savings, €375,000. The remaining employee handles exceptions and manages the system. The work of 4 became the work of 1 plus software in months, not years. That pattern has replicated across sectors: healthcare, insurance, logistics, finance. Data entry job postings have declined approximately 40% since 2020. 7.5 million positions are projected at risk based on AI accuracy and cost modeling. The BLS projection for information clerk employment shows a modest aggregate decline, muted, because some new roles partially offset the losses. The underlying rate of raw data entry volume decline is steeper than the aggregate suggests. For people whose job was specifically to bridge a physical or unstructured digital document and a database, there is no version of this job that AI does poorly enough to justify the human role. The accuracy is higher. The speed is higher, the cost is lower. The business case for human data entry and standard forms processing closed between 2002 and 2204. It closed without a press release. Job 4. The aide copywriter. This is the one that surprises people. The recruiter, bookkeeper, and data entry clerk carry the expected stigma of automation: repetition, volume-defined rules. Of course, technology would eventually absorb those, but copywriting? Marketing content? Creative work? The received wisdom on creative roles, human judgment, brand voice, emotional intelligence, and cultural context were irreducible. You could automate the transactional. You could not automate the creative. This position appeared in nearly every AI and jobs analysis written between 2018 and 22. By 2272% of marketers were using AI tools to generate written content, not to assist with strategy. to generate the actual output. Subject lines, product descriptions, social media captions, ad copy variations, email campaign sequences, landing page text. The turn happened fast enough that the industry caught itself mid-sentence. Sports Illustrated was found in late 2010 to have published AI-generated articles attributed to fake authors, complete with AI-generated headshots and fabricated biographies. The authors did not exist. Staff layoffs followed in January 2024. The publication that had employed writers and editors for 70 years reached a point where AI-generated content was cheaper, and a vendor was willing to supply it. CNET published AI-written personal finance articles containing factual errors. Corrections were issued. Approximately 10% of staff was cut in the months that followed. Those are the cases that became public because they went wrong visibly. The non-public version runs across thousands of agencies and brands. AI-first content workflows. One senior editor reviewing output that used to require 5 writers. Quarterly content calendars that once required a team, now requiring 1 person and a subscription. The math for the junior copywriter was particularly brutal. In 2002, a junior copywriter earned $35,000 to $50,000. Their primary deliverables were drafts, first versions of campaigns, product descriptions, email subject line variations that more senior people refined. By 2004, AI produces those drafts in seconds. One senior creative director generates 50 subject line variations from a single prompt in the time a junior copywriter spent on 1 round. Copywriting and content writing job postings declined approximately 30 to 40% between 2024. The roles that remained were senior editorial, brand strategy, creative direction, functions that supervise and refine AI output. The production tier writing function collapsed toward 0 cost. When production tier writing costs 0, the job of producing it at junior scale stops appearing in postings. The creative economy sorted into 2 groups: the people who design what AI produces, the people who used to produce what AI now produces. Both groups existed in 22. By 2005, only 1 group was consistently employed. The junior copywriter's job was to fill the draft tier. The draft tier is now filled by software. The people who built careers filling that tier are competing for senior editorial roles, a smaller number, with senior experience requirements, in a market that already has senior candidates from prior rounds of downsizing. The creative work did not disappear. The employment at the production level of creative work largely did. Job 5. The online tutor, the 5 numbers to know: 48, 30, 36, 49, 39, 48. Chegg's stock drop in a single trading day in March 2023, after the CEO mentioned ChatGPT on an earnings call. 30. Chegg's revenue decline in the first quarter of 2025 year-over-year. 36. The decline in the second quarter of 2025. 49. The decline in the fourth quarter of 2025. 39. The full year 2025 revenue decline compared to 2024. Each number represents students who did not renew, sessions that did not book, subscriptions that were not purchased because the alternative, free, unlimited, available at 3 in the morning, never impatient at a question asked 4 times, had become a real substitute for what Chegg was selling. The online tutor existed because students needed help and were willing to pay for access and patience. Chegg built the infrastructure, a platform connecting students with human tutors, a library of textbook solutions and explanations, a subscription model that made access affordable. At its peak, it worked. The tutors earned contractor income. Millions of students used it. The model had one dependency: students would prefer paying for human assistance over finding help elsewhere. ChatGPT eliminated that dependency. ChatGPT launched November 2022. Student adoption spread rapidly through the spring 2023 semester. Students paying $30 a month for Chegg discovered they could ask GPT-4 unlimited questions for free, or $20 a month for higher capability. The same student who submitted a calculus problem and waited 20 minutes for a human answer could type it into ChatGPT and receive a step-by-step explanation in seconds. The human tutor's time had value because it was bounded by capacity and expertise. It was replaced by a tool with effectively no capacity constraint. The human answered 5 questions per hour. The AI answered 5 per second. The human cost $15 to $25 per hour. The AI cost the student $0 additional at the point of use. Chegg's subscriber count fell 1% in the first quarter of 2025, and 40% in the second quarter of 2025. The company eliminated 636 employees, more than half its workforce, across 3 rounds in 2025. A stock at $115 in 2021 was trading under $2 in 2025. The platform tutors did not receive severance. They were contractors. The traffic fell. Students stopped arriving. Sessions stopped booking. Income stopped. No manager called to explain. No restructuring memo circulated. The marketplace moved. The tutors felt it as a calendar that stopped filling, as requests that dried up, as a first month without bookings, then a second, then a third. Khan Academy introduced an AI tutor called Khan Migo at $4 per month. Independent human tutors were charging $50 to $150 per hour. The comparison was not between quality levels. It was between price points for a service students perceived as functionally adequate. The specialized tutors, those working with specific learning disabilities, coaching for elite college admissions, building relationships with students over years, retained value. Because those roles are defined by the human relationship, not the content transfer. The platform tutor, the homework help tutor, the on-demand explainer of textbook concepts, their value proposition was content access and patient explanation. ChatGPT provided both better and cheaper. When a tool provides the same utility better and cheaper with no friction, the human providing that utility does not adapt the role. The demand moves. 48% in one afternoon. The market knew before the press release. 5 jobs, 1 mechanism. The AI tool reached adequate performance on the core daily work. Not perfect. Adequate in the dimensions that mattered enough to make the business case for human employment untenable. The recruiter who filtered resumes. The bookkeeper who entered and reconciled. The data entry clerk who moved information between formats. The copywriter who filled the draft tier. The online tutor who explained and answered. All were described in career guidance as stable, accessible middle-skill employment. Some were called safe from automation as recently as 2022. Safe because the work required human judgment. Safe because input variety was too high. Safe because clients and students preferred human contact. Each of those reasons had a price ceiling. Below the ceiling, the human preference held. When AI crossed below it, the preference dissolved. The jobs still exist as categories in occupational classification systems. The postings have declined. The headcount has reduced. The roles that remain require skills adjacent to AI supervision, rather than the original function the role was built around. This list is not a projection. Each of these shifts was documented and quantifiable by 2025. The question to ask about your current role, or a role you are considering, not, will AI eventually replace this? The question is, which of your daily tasks would a business move to AI immediately if it cost nothing? That question describes the timeline more accurately than any forecast. Leave a comment. Which of these 5 is closest to your current work? And if it is, what are you doing about it? Subscribe. Because the shift in this list is already documented. And the next list is being built right now. The shift has already begun. Now you know where it ends.